Most of the global trade today runs on the US dollar. If Japan wants to buy oil from Saudi Arabia, both countries settle the trade in dollars, even though neither of them is American. But why does the rest of the world use the dollar to buy and sell goods? And what exactly did the US do to make global trade run through its currency? From a macro perspective, linking global trade to one strong, stable currency is a smart move. Historically, that role was played by gold and other metals. But at the near end of World War II, the Allied nations came together and signed the Bretton Woods Agreement. Under this agreement, the Allies committed to peg their currencies to the US dollar, that is backed by gold. This arrangement made sense for two key reasons. One, the United States held roughly 3/4 of the world's gold reserves. Two, it was the only major economy to emerge from the war largely undamaged. The entire goal of this agreement was made to establish a stable and efficient foreign exchange system. But this didn't end well. When countries use a currency backed by a limited commodity, they cannot print more money to manage crises or to fund wars. So this Bretton Woods Agreement came to an end by the 1970s and countries started to use fiat money. In case of fiat money, the money's value is now determined purely by factors like inflation, interest rates, trade, etc. Now let's see how a typical international transaction works. A company in India wants to buy coffee beans from Brazil and needs to pay in US dollars. Here, the Indian bank doesn't directly hold Brazilian accounts, so it sends the money through its dollar account via correspondent bank. From there, the correspondent bank transfers back to the Brazilian bank. For a secure money transfer, country banks use SWIFT that acts as a messaging network. Over 80% of global transactions happen via correspondent banks, and the banks charges a fee for each transfer, making correspondent bank a lucrative part of the US finance. Now, you might have noticed that even after the removal of gold standard, the dollar still commands the global trade. There are certain factors that is strengthening the US dollar, but the real backbone is the US Treasury bonds. First, let's understand the difference between a bond and money. Money acts as a store of value, a medium of exchange to buy goods and services. Bonds are debt instruments where you invest money into it, whether corporate or government sector, and the borrower pays the money with interest. Investors willingly buy the US Treasury bonds because no matter how the market condition is, their money will be held safe, and this totally falls on the trust in the US government. But this system gets more powerful when investors from many countries seek to invest in the US bonds, which increases the dollar's value to remain as the world's reserve currency. Another factor that strengthened the dollar system was the Petrodollar arrangement. After the collapse of Bretton Woods system, the United States needed a new mechanism to maintain the global demand for the dollar. They needed something that replaces the influence of gold, and the answer they found was oil. The US made a strategic agreement with Saudi Arabia in the 1970s. Under this arrangement, Saudi Arabia agreed to price and sell its oil exclusively in US dollars. In return, the US provided military protection, weapons, and security guarantees to the Saudi government. Because oil is the most important commodity in the global economy, every country that wanted to buy oil now needed US dollars. So if countries like India, UK, or Germany needed oil, they have to earn dollars through exports, borrow dollars from financial markets, and use that dollar to buy oil. But here's where this process gets interesting. Oil exporting countries like Saudi Arabia earns massive amounts of dollars from the sales, and instead of leaving them idle, they invest this money into the US Treasury bonds. This is called petrodollar recycling. The United States positioned itself at the heart of the global financial infrastructure, and with that came one of the most powerful geopolitical weapons ever devised: financial sanctions. A sanction essentially means cutting an individual or entire country out of the dollar-based financial system. For example, if the US Treasury places a bank on its sanction list, global banks will refuse to transact with it, the access to dollar payments gets blocked, and the international trade for that sanctioned country becomes extremely difficult. Primary examples are Iran, Russia, North Korea, etc. Now let's see how sanctions at Iran works. Iran is accused for nuclear programs, missile development, human rights violation, etc. US imposed sanctions on Iran, which means many banks around the world avoid processing Iranian transactions, and if they do, they might end losing access to the dollar system. Again, they use the SWIFT messaging network to communicate these details. Due to these sanctions, Iran faces severe shortage of external resources, which then cripples the economy. From what we see, we begin to understand a fundamental truth about the dollar structure. A currency like the US dollar isn't just about facilitating the global trade, but about how it wields the world order. Yet, the dollar's dominance hasn't gone unchallenged. The BRICS nations have been actively pushing to settle trade in their own currencies, reducing reliance on the dollar. But the world hasn't found a reliable replacement for now, so the dollar remains in charge. If you enjoyed watching this video, hit the like and subscribe button, click the bell icon to stay notified every time I make explanatory videos, whether it's on AI, tech or economics. Thanks for watching, I will see you in another video.